I hate all these words. I hate EBITDA. I hate cap rates. I even hate the word free cash flow. They're escape hatches for lack of real work. And so I guess what I would say is I don't really classify assets this way. I ran a hedge fund for a long time. I had many mediocre years when I ran that hedge fund, but I also only had one down year in 20 some odd years, and we still made over 10%. And the reason we did that is because I think we moved beyond EBITDA, cap rates, and Sharpe ratios, and all these. This is stream, so I can't say any bad words. These malarkey terms. And what we tried to do is we try to visit the asset in such a way where we stress test it so brutally that we can come to the conclusion that the odds of losing money simply are low. I'm looking at a company now which is an industrial fall protection equipment company for workers at heights on cell phone towers. It has 50% EBITDA margins. It does, call it 10 to 15 million of revenue. But upon really rigorous examination, we can envision scenarios where one might get into trouble with the debt load that this company has. And so I try to avoid sort of cap rates or not cap rates. I mean, I'm looking at a building in Puerto Rico right now. Okay, the cap rate's 10%. Like, people say, well, that's good for Puerto Rico or that's bad for Puerto Rico. It's completely meaningless and totally sophomoric to even think along those lines. The question is the rent roll. The question is diving into every single tenant and meeting with them. The question is prevailing rents per square foot that are being sold right now. The question is what happened in the hurricane. The question is insurance. The question is whether the tile on the side of the building is going to fall off at 200 mile an hour winds or 180 in that town. So of course I care about valuation, and I would rather get my money. I'd rather pay 3 times free cash flow and get my money back in a few years than in 6 years. But I don't think that these words really tell the story. It's looking at the essence of the asset in a deep and penetrating and almost neurotic and paranoid way. If you really want to buy things well, forget cheap or expensive. Buy them well, because the gains will take care of themselves. One day we'll own this Puerto Rico building and cap rates will be down in Puerto Rico for some unknown macro reason, and we'll refinance it at 70 cents on the dollar loan to value. Boom, we'll have our money back then. So I'm not worried about the eventuality of all these random positives. I'm more worried about digging into the essence of what can cause death in the asset.